So, good morning, everyone. Welcome to our weekly webinar on this Thursday. We're still describing this as the lessons from the lockdown and still dealing with the current business climate that we all have to deal with. And today we are continuing a little bit on the theme of the MIRR and different ways of different metrics you can use for property investment. So we are doing that along with a project launch, 35 West buildings, as you saw from the promo. And we'll be looking forward to deep dive into that with Andy, our guest, in a minute. But once again, just to introduce my co-host, Mr. John Corey from our Property Fortress Partners. Good morning, John.
Good morning.
How is life in London today?
It's very nice, pleasant. I love this type of weather this time of year. I was out on the balcony a lot yesterday working with the virtual work office where you suddenly reposition to the good weather. So I'm definitely in a good mood today.
Yeah, we had a brief call yesterday, and when you tuned in your video, it was like sunglasses with the shard in the background as the sun was going down. I was just a little bit jealous as I looked at the cloudy skies over here in Northern Ireland.
Well, you had sun 3 days ago when I didn't, so I think we're just getting your sun a day later. So.
Yeah, hopefully. So today we're not going to do a market update because we want to maximize the time with our special guest Andy. But by way of introduction, for those who are sort of regular attendees who aren't aware of the Target 5 raise, so our platform is actually launching this raise today at 12 noon. Again, we're all very excited in the team. It doesn't seem that long ago since we had our previous raise, so it's great these projects are coming around very, very quickly. And this is a project that we'll go into more detail, but in terms of headlines, it's an HMO mixed use conversion. The target raise is 142,538. The minimum raise is 100,000, and we'll explain that later in the presentation. And the projected return on this project is 13.44% MIRR. Now, there might be one or two people are saying MIRR, how does that work? Again, that's one of the reasons for our webinar today. This is educational, it's about informing people, and we're going to definitely discuss that in more detail later on. 6-year project, minimum investment £100. And along the bottom, just to highlight straight away, again, as with all investments, capital is at risk, return is not guaranteed, and certainly read the risk elements, risk warnings, etc. On the project offer doc. So absolutely delighted to have Andy here today. So Andy, good morning to you. Do you want to just introduce yourself and maybe explain a bit about Target 5?
Good morning, David. Thank you for having me on. My name's Andy Babbayan. I'm the founder of Target 5 Property Consultants. We're based down here in Brighton, but we are sort of our area of focus for high yield properties is in central locations in Brighton, Hove, Portslade, Worthing and Littlehampton, across South Coast in Sussex. Target 5 has been running for 8 years. We've as a business completed more than 350 developments for clients and for ourselves. I set the business up really to sort of act as a sort of an ethical property development business that gives clients access to good quality, high yield and decent returning properties, and just sort of dealing in a really sort of straight talking manner. And this is this whole sort of progression for us moving on to the crowdfund we're really excited about. In terms of an introduction to me, I'll do me and then Tina, obviously, because I'm sort of slightly more comfortable with me. I'm an ex-army officer with a background in risk, ex-bomb disposal officer, and
yeah. Wait. Let's make that really loud and clear. You did bomb disposal and you ran a team of bomb disposal people, correct?
Yes, that's right.
So you understand risk at the sharp edge. I mean, you can't get any more sharp than that.
Well, some people might argue that there are, but certainly, it's an area where risk is absolutely critical. And one of the things, having had my fingers burnt historically in the last recession, the real thing about setting up Target Five was to find decent, high yielding, decent returning properties, but also to really manage risk. But I felt that the things that I'd done previously and where I'd been helped by people, they really hadn't considered risk. So that's what I sort of bring into it. I am a portfolio landlord with a decent portfolio, and I've got a lot of experience, especially in the specific areas that we're operating in and the specific geographical areas. And then a couple of years ago, I brought Tina in to the team, who's my business partner in both Target 5 and Sussex Property Partnership, which is our sister organisation, specialist letting agency. She was ex-president Brighton Hove Estate Agent Association, a very prominent estate agent, very vocal in the city, and we sort of found that we really shared a common view in the way that we approach business. So it was quite a natural fit. We are in areas where I am weak, she is strong, and vice versa. So that combined with the team that we have here, and we've got a really strong team: project managers, office managers, PAs, analysts. We all sort of complement each other. She's got a lot of experience. You can see from the number of transactions, and she's worked with a lot of developers as well. And she's also very well connected, and it is the connections in our network that make this business work.
Yeah, I was certainly impressed when I saw the CVs a few months ago, Andy, when your potential fundraise came through, and certainly both of you have got huge track record, huge credibility. You've kind of walked the walk, talked the talk, and all the rest of it, and that's always good to see when people are looking to raise funds, particularly through property crowdfunding, as they reach out to potentially new investors. I was always, when I saw the ex-British Army bit as well, obviously was especially relevant. I had 20 odd years as a British Army Reserve officer in the infantry, so no doubt we've walked some of the same sand in Iraq, and I don't know if you were there before me or after, but we could I'm sure share a few stories at some point, but that's for another day. So explain where this project is located, a bit about the area.
Okay, so 35 West Buildings is located in the centre of Worthing. It's literally 40 yards from the main pedestrianised street. It's about 100 yards from the sea. So very, 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 very central, and we can see it there. The building itself is a mixed use commercial with ancillary accommodation above. As I say, super well located, and an area that we really, really know well. So I own properties on adjoining streets. We've done probably 10 developments within about 300 yards of this place. So one thing that's critical for us is that it really helps with us understanding values, understanding the lettings market, understanding what the type of commercial tenants will be. But sort of critically, we always will pave the way by doing projects with our own money to know that they work, and then follow them up. The one way of sort of I'll take sort of more risks, if you like, with my own money than I will do when I do like this.
Yeah. Okay. No, that's good. When here,
so that's why we focused here. Really, it's basically like a really rundown building, and you can see it aesthetically, the photos and stuff on the rails. I wish we could sort of, they are what they are. And it really isn't. It's no oil painting from the outside, but what it's got, really well located, and it's got a huge amount of space, which makes it really, really versatile, completely in keeping with our strategy of then locating very centrally located properties that we can then improve the value square footage wise and the return.
Okay. So we'll jump into that.
We'll get to that, Andy.
Yeah. So a couple of things there on that. First of all, Q&A. I'm sure people are going to have a couple of questions. So we don't use the chat box. If you do have a question, please use the Q&A box. We did have a webinar on Tuesday night. There was like 15, 16 questions asked, and then Andy and Tina answered all those on the project forum, which you'll find on the pitch page. So a lot of the questions that may well be asked have got good answers already on the forum. But for sure, if you have any questions on something Andy says, fire in the Q&A, and we'll do our best to deal with it.
So
in terms of, so go ahead, John.
To clarify, so for everyone that is listening, if you don't already know, LEOcrowdfunding.com is the website where you'll see this raise. Each raise has their own pitch pages. That's what David means by pitch page. It's literally dedicated to this project. And it has different sections or tabs. One of those is a forum. And that forum will only have people posting comments who have registered on the site. So you won't get all the rogue behavior you get on some of these other forums. And if you have any questions, the nice thing about posting them there, so that all the shareholders or potential shareholders can see the questions, they can see the answers. You can get a more complete view of the investment opportunity when you're seeing what other people are asking questions about.
Yeah. Okay, thanks, John, for that. So here is the property, literally a couple hundred yards from the beach. And I believe from the offer document, Andy, this is an area the local council have targeted for sort of investment and regeneration for both commercial and residential. Yeah,
indeed. So it's essentially a protected parade. They see it as being because of where it is critical for the town. So they're looking to invest in it in the future, which is just nothing but a positive for the for this raise and for the whole street.
Yeah. Okay. So, talk us through then, sort of in sort of brief bullet points, the journey, how you sourced the property, your purchase price, how you arrived at that versus market value, and then just pick the key figures there from the screen and just give the attendees an overview, please.
Okay. So the property was offered to us via a local agent. It didn't ever go on the market. We then negotiated the purchase price. So they're initially looking for 300,000. We then negotiated down, I believe, to 265. We then had to renegotiate because there was some, and immediately we got structural engineers involved because we were concerned about some things, and we then negotiated the price down to where it is, 245,000. All of that work's been built into the renovation that we'll come on to, and as you know, it's nothing that can't be managed. So we then got the acquisition cost there, and a reasonably large scale renovation. We're stripping this completely back, and the key to these things is going to be the quality of the finish, both the commercial space and the residential above. We're going to go for and we'll go through some of the mood boards, but we're going to go for a really, really smart and innovative style, very, very practical as well. So it's all in standing around 407, and then with expected valuation, again, relatively conservative end value of 550, and this is really based upon stuff that we personally have achieved in the area, as well as sort of bang up to date valuations and assessments by local agents.
So in terms of if you call it phase one of the project, the purchase, the renovation, and the getting ready for tenants, there's a projected equity being created in the SPV of somewhere in the region of 140,000, depending on what the end valuation is. So, I mean, that's a pretty good exercise from a property project point of view to create that amount of equity before you then move on. So, in terms of the actual cost of 407, your bank funding at 263,900. We don't mention the actual lender on sort of public webinars like this. For those that have registered and downloaded the offer document, you'll be able to see exactly who the lender is, see a copy of their term sheet in the annex of the offer document. But it's fair to say, Andy, it's a well-known high street main lender that you're very familiar with, and they're comfortable with you, and you have a good relationship with them.
No. Someone said something. A really decent, conservative, high street lender. We've got personal relationship with with our relationship manager, who essentially also underwrites the lending. So it's a really close relationship that we've got, and they recognise the experience. I mean, I've known and worked with them for 5 or so years.
Yeah. Okay.
So
Right.
a quick point about this, and just so it's clear to everybody. So I'm actually a consultant to Target Five, so I know quite a bit about the background and all this. The lender's already committed on the exit valuation. Is that correct?
Yes, that's right. Yeah.
Okay, so this is not the expected valuation. The lender's already issued a commitment letter to refinance the property after the work's done based on these numbers. So they've already told you that they will refinance it. So they're already happy with what they think will be the result.
Yeah. No, that's a good point.
And the lender, who we won't name, are one of the potential exits. But we will wait to see what the best what's best for the project, if you like, at the point, or close to the point of refinance.
Yeah. Okay. So want to wrap this up pretty quick and get on to the next one. But the investor funding portion, the part that is coming to the platform to be raised, 142,538, and the funds coming in. One question that investors always want to know is, so what will my funds be used for? So while this is sort of one project with sources of funds, in terms of the money from the raise, what have you allocated that against, or how do you intend to spend that?
I mean, the money coming in goes into the SPV for the whole project. But as you can see from the figures, broadly speaking, that money is going to essentially finance the renovation works. Okay,
so there's what's been done in the renovation. So do you want to just sort of quickly explain the layout, the ground floor, and the residential units? Because I know there was actually a slight, haven't worded that very well on the top line. So just explain the residential element of the unit.
Okay, so it's a commercial unit, and it's a very versatile space. So we've our plan A, if you like, is a 3-bed and a 2-bed unit above. So can you sort of making use of permitted development rights, and because we've got the opportunity, because there's 2 entrances from the front and an entrance from the back. There's rear access as well, which is one of the principal advantages, which means we have the opportunity to create 3 distinct units. So that's what we're looking to do. In terms of the works, this is a complete rip out. So it is in poor condition. There are structural works we're going to do to the front bay and to shore that up. Obviously, all in line with building control and with a very well respected structural engineer who's visited the site a number of times. And then it's going to be new windows. There'll be a new front, and then completely redone inside, as well as the necessary soundproofing and insulating works that we need to complete the conversion, and then moving on to a really, really sort of high-end co-living type feel for the space. We are going to be renting the residential element to professional sharers, and those people who follow us on Instagram and our Facebook will see that we're really, really working hard on the quality of our finish. We've recently set the bar in terms of refinance valuations for similar co-living space we just finished in Hove. So we're really just making sure that we get the aesthetic right, but just as important, as the aesthetic, the practical elements. So of course, we need to comply with all relevant legislation in terms of any licensing and whatever, but also we're looking to future-proof. So we're looking at what's considered best practice, very conservative in Brighton. We're applying what we do in Brighton to Worthing, even though they're not doing that yet. So we're making sure that we then future-proof the investment, as well as making sure we've got all the practical considerations. So internet, USB, all of these things, so it becomes a nice place to live as well.
Yeah, I think it's really cool when I saw the mood boards, because I think it shows the way you approach these projects, yourself and Tina, because there's always this big debate sometimes in HMOs, and you get sort of the cheapest material to maximize the yield, and you end up with magnolia walls and cream carpets because they're the cheap ones you can get from somewhere. Whereas you guys have taken real care in terms of the design, in terms of the feel, in terms of the aesthetics, which should mean you're going to get better tenants and higher rent. But it's a quality that I think you have to offer in this day and age to get the right quality of tenant.
Exactly, it's the right quality of tenant, the right rent, but also you have to remember it's an experience for people living there. We want to sort of advocate the right type of landlordism, and there are moral and social responsibilities that come with being a landlord, and these people, this is their home, and it's very easy to see them as people who are paying a decent rent, and just look at it like that. But these people, we sort of view them as they're our residents, and they've got to enjoy the experience, and yes, it means that they're going to pay a decent level of rent, but also they're going to want to stay there, because if you sit at the top end of what's available, then why would they move? So they may as well that means that you've got the right level of occupancy and you've got longer tenancies as well.
Yeah, brilliant. Okay, so we've got about sort of 10-12 minutes left of the webinar, and this is the real I suppose key slide from an investor point of view, and very much from the point of view of our sort of educational side to the webinar, and understanding the model, because it is quite an interesting model you've chosen. So I don't know, Andy, if yourself or John wants to go first, just to explain the concept of why this MIRR as opposed to a normal way investors maybe look at a deal. So I'll let you two sort of discuss that.
Let me start, because I'll give the theory. If you have a multi-year project, which is what this is, and you have cash flow out, cash flow in, so repairs before it's rented up, and then you get rented up, the simple ROI calculation completely misleads investors. It's just the wrong calculation. It will not accommodate the different directions in the cash flow, which is what this diagram shows. And in particular, one of the things that's happening is if you're getting 72% of the money you put in back in the first 12 months from the refinance, and then a series of cash flows later, this is like buying and holding a property. You add value, you refinance, you recycle your cash. Well, the best way to measure that is with a formula that can actually accommodate the different flows. And so when you read the literature, when you search around, IRR is classic measure used. IRR is actually unable to deal with this type of complexity. So they created MIR, which is modified IRR. It's built into every Excel spreadsheet as in a standard formula. So everybody has access to it. Most people don't use it. They're essentially blundering in the dark, not knowing that they're misreporting numbers when they do ROI. It's just, it's a competence issue, so.
Yeah.
Yeah, I'll say, I mean, this, as you know, you both will know, this has been a little bit of a journey for us in terms of getting to this first raise. But part of that, and it was really, really important for us that we really accurately reflected the nature of this raise, so that it's clearly communicated to people from a sort of a moral perspective, but also from a legislative perspective, and this just seemed to sort of work best. And I have to admit, it was an education for me going through this, because even though I've been doing buying, refinancing, recycling cash, and essentially doing this, in the way in which we've been measuring it, as probably not saying been inaccurate, because it's been accurate in the terms of which we've set it out, but it's not properly reflected the nature of the investment, which is what this does. So
that's a really good way of actually putting it. It's not that other ways aren't right, if that's how you set it up, but this definitely peels back the layers, and you get a much truer reflection on how your money's working for you. So take us through step by step. We've used £100 here because that's the minimum entry level, which effectively buys a share. That could be a multiple of whatever someone wants to invest. But just to talk us through briefly that journey then. So an investor gives you the £100 at the start of the project. Explain from there, please.
Okay, so and obviously the money comes through and is dealt with by solicitors and all these accountants and whatever. But this is sort of set up just to really sort of show what it would be like with a nice round figure that also happens to be the minimum amount, £100. So broadly speaking, you put the £100 come in. Hopefully, so from 12 today, we're going live, and hopefully we'll reach our level of investment. That money will then come through to into the SPV, and then be made available to facilitate the project as described in the offer document. Now, the plan is we go through, we develop the property as described, and then refinance. We've put it in here to make things easy at the end of year one. Now, it is reasonably likely that we'll do it within that time, but that's the target backstop, if you like. And from doing that, and as we've seen from the figures, that will then release a load of money that will then finance paying any finance costs to the main lender, to the bank, and then pay back, as we've got from the figures here, 72% or thereabouts. Now, the reason these figures are very, very accurate is we've literally taken, it's all calculated on a spreadsheet, and therefore we've just tried to communicate that as accurate as we possibly can. It may be that these figures, change slightly up or down. We think we've been reasonably conservative. But so based on these figures, 72% comes back at the end of year one for them people to be able to reinvest into other raises with ourselves or other people, or do whatever they wish. They then going to get 50% shared out of the operating profit, which is the rent that comes in less the costs associated. So, and that's laid out in the offer document, but the sort of management fees, maintenance, even tax. So they then essentially get dividends throughout the project up until the end, where they then get a final dividend, if you like. They then get the balance of the money that they've invested back, plus a pro rata share, 50% share of any capital appreciation over and above the refinanced amount, and that's reflected there. So again, we've made the assumption that over that sort of that 5-year period from end of year one to end of year 6, that it would be 10% increase. So that's where that figure comes from. Again, that could go up or down. We've seen that as being a very sort of conservative figure to work it out on.
Yeah. So you're assuming, Andy, the 550 valuation at the end of year one, approximately when the refurb's all done, a 10% uplift on that number, so about 55,000 increase, so close to 600,000 by the year 6. If it's higher or lower, the reality is it's higher or lower, but that's the projection, is that 10% is for the 5 years.
Exactly.
Yeah.
And that was based upon looking at sort of the most conservative forecasts when we were looking across.
Yeah. Okay. Yeah. So in sort of wrapping that up, it's £100 in at the end of year one, potentially around about £72 back in the investor's pocket, which I think is really, really interesting, because the investor can then take that amount of funds they get back and reuse it elsewhere in other investment if they want, and yet they're still getting the value of their initial £100 investment. So I think it's a really cool model for professional investors and people who want to have their money maximized for them, sharing the rent, and then at the end, last year, you get your rental share plus then the buyback. So that's kind of the journey, and that's the reason we use this MIRR, 13.44%, per annum. That's the best metric to sort of show what your money's doing for you over that time. Now, I did say that the share price is £100. I'm actually wrong on that. It's actually £1 a share, but the minimum investment is £100. But the offer document will explain that. So that's the details. You can get the offer document, and obviously there's more details on that. All the analysis spreadsheets for each one of these figures that Andy's mentioned is annexed in the offer document. It's very detailed, and you can work it out month by month, which is great. So this project goes live for investment at 12 noon today. So whatever that is, 2.5 hours time. it goes live. So what I'm going to do just to wrap up here, and then Andrew will bring you in just at the very end, I want to just highlight a couple of points about registration, because sometimes investors don't fully understand the difference between registered and investor ready, and only those investor ready can actually invest in the deal if they've so wish and done their DD, etc. So as John mentioned earlier, when you go on the pitch page on Leo Crowdfunding and select this project, there is a forum that you can access all the questions that have been asked and answered, and Tina and Andy have been very, very, very available. I think within 12 to 14 hours, every question that's been asked has been answered directly by them, which is brilliant. So thanks, Andy and Tina, for that. There is this recorded interest box. That's a wee bit redundant now, because obviously at 12 o'clock you can actually go and make your investment if you so wish. Now, just to be very clear on one point, we of course as a platform, while we're hosting the project, we are not recommending this or giving financial advice in any way. What we do is confirm that the information in the offer document has been tested. We have asked Target 5 where they've made claims about the market or claims about their rental projection to provide evidence for that. And we've also looked at the numbers to confirm that it stacks up. So it's a case of we've DD'd the information on view, but we're not, if you like, standing over the background to that. T5 represented it, and we're literally confirming they are who they say they are. We've done DD on them, we've done DD on the SPV, the legal entity, and all of that. So just to make that distinction, in case anyone's not sure about that.
Yeah, just David, when you said the numbers stack up, all you mean is that the math adds up as presented. You haven't actually signed off or verified that the numbers are reasonable. You have no opinion on that level, right?
Yeah, correct. So we say numbers are reasonable. We have tested it that it's accurate in terms of market value. So the renovation cost, the rental comparison, we've tested what is the rental average in that area. But in terms of their overall, any project's overall numbers, all we're doing is making sure that the columns total and that it's a robust and stands up to anyone who looks at all the formulas. So, it's definitely accurate.
I think you may be digging a hole here. So when you say you tested the rents are right, the values are right, the construction costs are right, what do you mean by you tested as Leo Crowdfunding?
Yeah, so our staff would, if they claim that the average rent, because they've obviously put their rental figures, then we will independently look at rental valuations in the area, what is the average, to make sure they're within the margin of an average rent in that area.
Okay, so
in terms of refurb costs, we'll have a look at it, and making sure that what they say is going to cost X amount is industry average. So it's tested at that level. Okay, so in terms of the platform then, again, I always like to highlight, we are, as Leo Crowdfunding, an appointed representative of a company called Sharon. We are authorised and regulated by the Financial Conduct Authority. And this investment is not offered to the general public, and that's why people have to register on the platform before they can view the information and actually invest if they so wish. So when someone lands on the page, there is a register to invest and a login to invest. So if someone hasn't registered, then they need to go through the process of registration. That involves some initial information, name, email address. There's an email confirmation, and then they'll have an account top right-hand side of the homepage. You'll be able to click on account, and then you'll see profile and portfolio, etc. So once you go into profile, you then have to complete a couple of steps. There is KYC, uploading ID. It may ask you for a proof of address for AML, and then you do a investor readiness test, and that's a series of multiple choice questions that just demonstrates that the investor understands the nature of investing through a property crowdfunding platform, understands the nature of risk, understands that they're making the decision to invest. You want to come in there, John, on something?
Yeah, so I just want to highlight that people can invest as an individual. You can also invest as a company. You can invest as a trust. Those are highlighted in the left side where the arrows are. So you can make a decision as to what type of investment, or where your investment's coming from. As a sort of tangent, Americans and Canadians are not allowed to invest as individuals, but if you have a British registered company, you can invest as your company, even if you are obviously speaking with an accent like I am.
Yeah, okay. And then the other very important thing is that you designate what type of investor you are. And this is a very, very important part of the process. Restricted retail investor, sophisticated high net worth. And that's important in terms of how we interact with you in the day-to-day dealings of the platform. So once you've done that, then you will receive an email to say you're now investor ready. Then at that point, you can actually go in and, if you so wish, having done your due diligence, read the offer document. There's how it looks. You download that. You also can see here the Target 5 selection criteria. So Andy and Tina have made available, which is very good of them, their sort of criteria they looked at before deciding to purchase this property. So you can go in. Once you're happy you want to invest, you then select the amount of pound sterling you want to invest. That will tell you how many shares that financial amount is purchasing, and then you move to the payment. And it can either be transferring to an e-wallet, and then the money sits there, or it can come from bank transfer into like a holding account for the project. So the money does not transfer to us in terms of Leo crowdfunding, nor does it go to Target 5. It's simply there, if you like, in a holding account. There'll then be a shareholder agreement that you get a chance to have a look at. And once you're happy with the shareholding agreement and click accept on your admin section, only at that point does your investment become an active investment. And when the fund or the raise is closed, the funds then transfer to Target 5's SPV. So that's the flow of funds. If you have any questions on that, of course, reach out to us and we'll happily deal with that. John, was there any questions you want to deal with quickly? We're sort of slightly over time, but is there anything urgent or?
No, I mean, there's a few people asking questions that I responded to in text by typing, but everybody should be able to see it given the way I answered it. I think generally people should go look at the official documents and go to the official sites. That way everybody's getting the same information. And if there are questions, you can post them in the forum there. But the people at Target 5 produced a rather detailed, lengthy document. Most of it's appendix to back up the statements they've made. So there's plenty of quality information there to review before making a decision.
Yeah. Okay. So that will wrap us up for today. Andy, thank you for your time. Any sort of 30 seconds, last points or comments you want to make?
I just wanted to thank everyone for their time this morning, and for you both and the support and getting to where we're at. I mean, we're really excited about this because it's been quite a lot of work for us, time and effort and whatever, and and money to get to this stage. But this is for us. This is sort of the start of a journey. We're really excited about doing this project with a view to then following with other similar projects, and then to build relationship both with this platform and the investors. So no, we're really excited.
Brilliant. Okay, well, listen, again, Andy, thanks for your time, for making time to be here today. And yeah, we'll leave it there. And those who wish to invest in this project, you can do that if you wish at 12 o'clock noon. Any questions, reach out to us and we will be able to try and help you if we can. So all the best, everyone. Have a great day and talk to you again soon.
Thank you all.